We're getting close to the end of our program for this year. Right, we have one more event, which is on May the 13th. That's with Elaine Buckberg from the Salata Institute at Harvard University, talking about, I believe she's going to be talking about like climate and climate change and sustainability and things like that. So put that on your calendar. 4 weeks from today, we'll be back here for the last time before we take a hiatus for the summer. The board is already kind of thinking through where things are going to go next year. We've already kicked around ideas. Hopefully we'll be able to follow up what I consider to be like a really strong 2023-2024 program with another strong year next year. Other club business. The scholarship deadline has come and gone, right? So I've been talking about it the past couple of months. But keep in mind that we do take sort of the extra money that we raise from membership fees and corporate memberships, and we take that and we give it back out to students. We have a number of applicants. I'm on good authority that the scholarship committee is hard at work analyzing the different applications and trying to figure out who deserves the money this year. The plan is to have an announcement for the winners next month at the meeting when we conclude the program year. Okay, so thanks to everybody that spread the word and helped get applications in. We're working on just evaluating the applications now, and we'll announce a winner next month. With all that said, it gives me a really great pleasure to introduce today's speaker. Oh, that's right. Before we get started, I forgot John Hudson is back with the joke. He wasn't around last month, but he told me he had a lot of good stuff this time around.
Wow. I don't know if you call it a lot.
I only need one.
I went to an economics conference a few years ago, and at lunch, people got out and walked around the courtyard, and there was an economist from Harvard and an economist from the University of Chicago strolling in the courtyard. How do you identify the economist from Chicago? It's the person doing the random walk. So you got to be an older one. If you don't like that, what do economists and computers have in common? You have to punch information into both of them. So there you go. Those of you who remember punching data running through SPSS, graduate school in the 70s.
I feel like you're giving me nightmares. Again, it gives me really great pleasure to introduce today's speaker, Jamie Lane, who's the Chief Economist and Senior Vice President of Research at AirDNA, which is the go-to source for short-term rental data and insights. He spent about a little over a decade in the commercial real estate industry, particularly on the hospitality side of things. He's the leading voice of authority on the health and the outlook for the short-term rental space. Frequently cited, if you pay attention to the kind of movements in short-term rentals, you see Jamie's name pop up in the Wall Street Journal or Bloomberg, the New York Times, just trying to get his opinions on where the short-term rental industry is headed. Before joining AirDNA, he spent around a decade at CBRE, again in the hospitality space, and he helped build CBRE's econometric advisors group out. He also has the distinction of bringing a young Ibrahim Ban into the commercial real estate space. I don't know if you view that as a positive or negative. I'll leave that up to you. But once upon a time, he thought it was a good idea. He has a Bachelor's of Science in Economics from the University of Georgia, a Master's of Science in Business Economics from Georgia State University. So please join me in welcoming Jamie Lane.
No regrets on that hire. It was a great one. It was a lot of fun working with you all those years at CBRE too. So thank you very much for the invite to come and speak. I have been a member of the Atlanta Economics Club for years. I was trying to think of when I spoke last. It might have been like 2014 or 2015. It was a long time ago. It might have been when it was still PKF before we got acquired by CBRE.
I guess you're around here.
Yeah. I've been trying to come back. I'll be back. I'll try to make it next week or next month. So we're going to talk about short-term rentals. May seem like a relatively small, obscure sector, but it is growing. So if you think about overall travel and lodging spend, today about 25 cents out of every dollar that's spent on lodging goes to short-term rentals. And for a industry, the hotel industry, broader lodging, and globally that's a $600 billion industry. In the US, there was $66 billion spent on short-term rentals. So not a overall small, or as small as you might think, part of the overall economy. And in certain markets, like think where you go on beach vacations or ski trips, short-term rentals are the dominant form of lodging where there just aren't a lot of hotels. And I think it's a great sort of bellwether of sort of discretionary spend, because travel very much is a sort of leisure good, and it is something that people spend on when times are good. It's one of the first things they sort of cut back on. Like if you're gonna look at your sort of wallet spend, of like, all right, do I wanna go on this trip? Do I wanna stay for a week? Maybe we only go for 3 days. And that, it is very much a good indicator of where the consumer is at. And right now, things are pretty good. So I'm gonna start with a slide. You guys may have seen it. Tell me if you saw it out there. As an economist, as a data scientist, as a visualization guy, this got me really excited. And sort of the feedback I got was really exciting too. So, did anyone see this chart? On Monday. So, I posted it 2 weeks ago. It has now had over 10 million views on Twitter. So, for what it is though, so what we did was we looked at every single city in the US, what the occupancy was for that city, and it was a GIF. I think I just put the view of April 7th. But what it clearly showed us was how strong bookings were related and along the eclipse. Every single city essentially booked solid. Really exciting to see, and really exciting to see like the feedback from everyone, just of loving the visual, loving the sort of trend around people traveling to see this like event that only happens maybe once every couple decades. We did go back and look in 2017 when it came across the country there too. Exact same trend of sort of the streak of red across, except it came across the other side of the country. So fun chart, fun sort of way to play with data visualization that we were able to do. So when we talk about short-term rentals, I'm going to show 2 data points. 2 of the largest public companies in the short-term rental space. And there's only like a handful of public companies in the short-term rental space these days. One that came out with their public reported data that they were down 19% year over year for gross booking value. That's how much people are booking through their platform. Talks about how demand's softening, how it's just a really weak environment out there. And then the other, saying that guest demand remains strong, growth is accelerating, and we're driving affordability for guests. So if a company's talking about how they're making things affordable for guests, and revenues were up 15% year over year, that's really good. Anyone have any guesses on what company's on the left-hand side? So things are weak. They're a large public company in the short-term rental space.
VRBO?
They did have a weak year though.
Airbnb.
That was Vacasa. Anyone ever heard of Vacasa? So they're the largest property manager in the short-term rental space. So they're the ones actually going in and cleaning the units. They've got about 45,000 homes that they manage in the US. They're the world's largest property manager. And then the one on the right is Airbnb. So Airbnb is where someone lists the bookings, lists the homes. Vacasa is the one that's managing those homes, doing the cleaning, sort of turning them over, bringing the guests in. So 2 companies in this space interacting with the exact same listings. One saying things are great, the other saying things are terrible. So anyone have any ideas on how that could be happening in the same sector of both up 15% and down 15%. It's one word answer that sort of works on both sides of the equation.
Well, they're not cleaning the houses as often as they used to.
So,
Tell
you think that would make the
the
labor?
renters to change their own shoes.
Lower prices.
No,
Labor intensity.
no,
Length of stay.
no,
Inflation.
no.
Competition.
Competition is supply. So supply goes up, no matter how much it really goes up, that's great for Airbnb, they've got more units to sell. Supply goes up, that's more units that Vacasa has to compete with. Because they've got sort of fixed supply, their number of units isn't going up. Overall industry is going up 20%. Vacasa's units essentially staying flat. They've got 20% more supply they're working with, their occupancy is coming down, the rates that they have are going down, and they're really in a tough competitive environment. So supply. And in a sector where hotels supply grows 1-2% a year, and we'll look at the data, in the short-term rental industry, in 2022, supply was up 25%. Last year, supply was up 14% in 2023. This year, supply so far is going up around 10%. So the supply changes that are happening are dramatically impacting performance in the sector. And this sort of breaks it down a bit. This is year-over-year change in the key metrics, so occupancy, so each unit, how much is it being occupied? ADR, what is the rate that someone's able to charge for that unit? And then RevPAR is the combination of occupancy and ADR, essentially the average revenue being earned on each unit that you make available. And so you see every single sector on the price tier is seeing declines in occupancy. The biggest declines in occupancy are on the luxury tier. Every single sector except luxury is seeing a decline on rate, and all are earning less revenue today than they were last year. So what I find really interesting here on the higher end, essentially if you got a really high-end home, you're unwilling to come down on rate. And typically luxury rentals run the lowest occupancy because people do sort of have that floor in their head of like, I've got my nice home up in the mountains, I've got my nice home at the beach, like I don't want to cut rates because that might attract a guest that I don't necessarily want staying in my $1 million home. So what we see is, yeah, you can make that decision, but that's going to impact your occupancy significantly if you're not able to come down and people sort of trade down and have a price point they're willing to pay. And what we're seeing is worse performance for the luxury properties on a rate side or on occupancy side compared to the others, but really weakness abounds for the industry. And I talked about sort of supply, but what I wanted to show was essentially what this cycle has been. Essentially, we've seen an entire business cycle for short-term rentals in a 5-year period, which you guys are 4-year period. You guys know business cycles. Usually they're like 10 years, and we saw it super compressed. So 2022, things were good. Everything was growing like 15-20%. Supply and demand were roughly in balance. We were at record high occupancy levels. COVID happens. Travel pulls back, and short-term rentals saw that. So the green line, you see it start to drop quicker than supply. But one thing, and then supply contracted too. Supply was really interesting for short-term rentals because for most commercial real estate, hotels, office, some of the other ones that were sort of impacted, yeah, you could close down your hotel, but you can't really convert a hotel to some other use case very easily. You can't convert an office building to some other use case very easily. You can convert a short-term rental to other use cases, and we saw that. In urban areas, we saw people get rid of listings and convert them to long-term rentals. In vacation rental markets, you had homeowners that had a second home in that market, they were renting it out. All of a sudden they decided, like, you know what, I can live and work anywhere. I'm gonna work from my second home, and I'm gonna pull that inventory out of supply. So we saw a 20-25% decline in short-term rental inventory in 2020 and 2021. We got to 2021 though, and people were tired of being at home, and they started to travel. And they weren't necessarily yet okay staying in hotels, but they were absolutely okay staying in an entire home that they rented out and didn't have to share with anyone but their immediate family. So we saw demand come back very quickly. So demand was fully recovered from the pandemic in April of 2021. So that took 13 months for a full recovery in a sector that was just decimated by the pandemic. But supply didn't come back that quickly. So that meant we reached record high occupancies in 2021. And I'll show you the next chart sort of lays that out. And it took a long time for sort of supply to get back. But once it got back, it came back with a vengeance because occupancy levels got so high. There's so much pricing power for short-term rental operators. So the sort of dynamics of, I can really make money in this sector were happening. Supply up 25% in 2022, fully recovered. And then the past few years, we've seen supply continue to grow. We're now 35% more listings today than pre-pandemic. And we'll sort of show the areas that that is in. And when you look at occupancy, and this is sort of almost like boom and bust cycle of, because you typically don't get that much movements in terms of short-term rental occupancy. So we were pre-pandemic at about 56%, reached a high of 62% in 2021, and now we've seen 3 consecutive years of declining occupancy, which is playing into Vacasa's sort of weak results. Now we do look like we've sort of plateaued at around 55%, and sort of our theme for 2024 is a year of equilibrium, because we've very much been in disequilibrium for the past 4 years. And so now hopefully we get some sort of calmness in terms of changes in occupancy that allow investors and operators to more easily plan on what the future is going to hold. Because when you look at it by city, and these, we sort of break out the top 50 vacation rental, short-term rental markets in the country. And we've got 2 sort of comparisons. The green is versus 2019. And you see about half the market still well above 2019 levels of occupancy. And then the blue is year over year. So like I said, this every market decline. But when you look at the markets that are still well above 2019, it's Breckenridge, Lake Tahoe, Gulf Shores, Hilton Head, the Big Island of Hawaii, Sarasota, Charleston, Destin, like all these sort of vacation rental markets still doing really well. So when you look at Vacasa relative to 2019, like the company's still doing great. It's just coming off some real highs that were tough comparisons. And then when you look at the markets that are still well below 2019 levels, it's most of the major cities. So Oakland, Dallas, Philadelphia, Atlanta, Houston, Los Angeles. Atlanta was actually fully recovered in terms of occupancy going into 2023. Anyone have any idea what really hit Atlanta hard for lodging in 2023? Especially short-term rentals and people coming to the city and staying for like 1 to 3 months. No? I should have brought a prize for this question. This is one of my favorite sort of short-term rental trivia questions. There's the writer's strike and the actor's strike. So the short-term rental operators here, like, they really benefit from the growth of the sector. And sort of there's entire midterm rental companies that sort of operate in this short-term space of renting out to actors, writers, sort of production crews. They want to come stay in town. They don't want to stay in a hotel because they're here for like 1, 2, maybe 3 months at a time. And short-term rentals are perfect for them. And the pullback that we saw from sort of production sort of stopping in Atlanta really impacted performance for those operators. That's the city. So that question of like weakness persisting across the industry sort of causes me to ask, and us to get asked a lot, are guests still traveling? As you think occupancy down significantly, that means people are pulling back, right? The answer is no. So when we look at overall demand for travel last year, so short-term rental demand was up 6.5%. Air travel was up 13%. Hotel demand was up 1%. Cruise demand was up 77% last year. Cruises, as of 2021, were off 90% compared to 2019. They're now above 2019 levels. The recovery in cruise demand has just been unbelievable, as is air travel. And sort of riddling this, we've got air travel up 13%. We got short-term rental demand up 6.5%, hotel demand only up 1%. How can air travel be up so strongly year over year, and forms of lodging where people are staying in the US actually, and hotel demand was actually down the back half of 2023. Like Q1 was the only quarter that hotels was actually positive. So a big piece of that is air travel leads to cruise travel, but also a return of international travel. So just because people are flying doesn't mean they're traveling domestically. And the recovery of international travel has really impacted domestic lodging, so US hotels and short-term rentals, pretty significantly. Because that was like the last thing to sort of recover in travel, is getting back to cross-border travel. US is sort of struggling, and I'll talk about it in a bit on why that is. So the factors sort of going into hotel demand and short-term rental demand, overall lodging, we look at employment, real personal income, consumer spending. So do people have jobs? Are they earning more than inflation? And it usually leads to spending. And that's sort of the main factors that we look at, and overall things are looking good. And when we look at overall US demand for short-term rentals over the past year, the only area that we see a little bit of weakness is in the sort of lower, smaller units, so private shared rooms, studios, maybe a little bit in the 1 and 2 bedrooms. Area that we see the strongest growth is in the larger units. It actually lines up really closely with what we see happening with hotels too, where hotels only up 1%, down the back half of last year. The type of reasons why people are continue to travel is really benefiting sort of the like family travel, group travel, use cases that sort of benefit short-term rentals. And then what I was talking about with cross-border travel. So we've broken up demand in a few different ways, and we sort of start with US demand being up 6%. Domestic demand, though, on a year-over-year basis, only up 4%. Now you've got domestic outbound demand on a year-over-year basis. So this is the number of Americans traveling overseas, up 22% year-over-year. So if you think about, and we're all in Atlanta here, we're maybe all going down to Panama City Beach, the Redneck Riviera, past few years. Now it's clear we're trading the Redneck Riviera for the real Riviera. And that's been a trend over the past 18 months, and those sort of coastal markets are really seeing, and some of them are actually seeing pretty significant declines in demand because of the metro areas and the sort of price tier that they were pulling demand for. And now those travelers choosing other destinations that were really popular during the pandemic. Fortunately, we are seeing a big pickup in foreign inbound demand too. So foreign travelers are coming to the US. But I can tell you, foreign travelers aren't going to Panama City Beach when they come to the US.
Jimmy, you're talking all about vacation travelers.
Yeah.
What do you think is the mix between the private vacation travel versus the business travel?
Yeah,
on that international.
Yeah. So for business travelers, I mean, primarily are staying in hotels. As of last fall, we saw a full recovery in group travel. So those people going to conferences, conventions, actually a big driver of international travel, business international travel, that was fully back in the US in October for the first time since the start of the pandemic. Overall, corporate travel is still about 90% of 2019 levels. So we haven't seen a full recovery yet of just general business corporate travel. And a big piece of that is just the rise of Zoom, virtual meetings. Like Bill Gates famously said during the pandemic that he thought 50% of business travel was going to permanently disappear. So far it looks about 10% of that might disappear. And I was at a meeting 2 weeks ago where Ed Bastian was talking, the CEO of Delta. And because they see that very clearly in their data of the time of someone going for a one-day meeting is over. Like the time of you going to London for 1 day, 2 days, and flying back is like, that's gone. And he's like, that's gone in a good way. Like no one should be doing that to their body. No one should be doing that for business travel. And now people are realizing like they can do those meetings on Zoom. And he's like, from Delta's point of view, like even though there's lost business, we're okay with that lost business. But the longer travel, like people now that are going to Europe for a business meeting, they're not going to add on 3, 4, 5 days, a week or two, because they can work remote while they're there, and there's not that sort of need to get back quickly. And that's adding, and why it's a hard question, is the sort of rise of leisure travel has grown so much. So leisure, I hate this word, but it's like you sort of pushing together business and leisure travel. The other thing people call it mullet travel. So business in the front, party in the back. That is growing very strong. And when you look at foreign inbound to the US though, versus 2019, it's still not fully back. So overall US demand up 30% compared to 2019, and foreign demand still not back. So Americans are going overseas. That demand is up 30% versus 2019, but we are not yet attracting our fair share of international travelers to the US. I think a big piece of that is out of our control. It's the US dollar. The US dollar is still very strong relative to other currencies. The other piece of it though is our sort of visa system for sort of issuing visas to foreign travelers is not nearly at the capacity it was, and isn't sort of like for Indian or Chinese traveler coming to the US, some of the biggest drivers of global demand right now, it can be a 6-month wait to get a visa to come to the US. So you think about like wanting to do that trip, or someone sort of deciding 6 months ahead of time and then getting in line for a visa. That is very, and China was the number 2 country for inbound travel to the US prior to the start of the pandemic. So we are missing out on a lot of potential guests that could be coming in because we just aren't processing people quick enough. So that's the demand side. And now we also have the supply side. So this is in the US. We look at supply of short-term rentals, and I divide it by 6 different location types. And sort of the summary I give is like, you've got the large cities, so this is Atlanta, New York, and we divide it between urban and suburban. Urban areas are not back, still below 2019 levels. So demand for major cities, a lot of that corporate demand that was staying in short-term rentals in the urban core, not back. Suburban has been a bright spot, especially for stays more than a month. So people wanting to use short-term rentals for sort of that in-between of like, I want to move to a city and take a 1-year rent lease, or I maybe just want to try this city. I am staying in different cities, one city every month. It's a really popular thing now to sort of live on Airbnbs and travel around the world and do it like a month at a time in each city. Where we've seen the most growth though is in the small and mid-sized cities. So this is rural America, this is Birmingham, this is Chattanooga, this is sort of everything outside the major coastal and mountain and big cities. This is where we've seen massive growth. In rural areas of the US, supply has doubled since the start of the pandemic. And then some of the best performers, still decent supply growth, makes up just less than half the short-term rental inventory. Mountain coastal areas have been doing very well. We did see a slight decline in 2020 in supply, but that has quickly sort of got back and is now accelerating in terms of growth. And then the other sort of part of the equation is price. So you combine supply and demand. So there's been some wild volatility in terms of price. So ADR is essentially the average guest paid rate. So as you're sort of staying in a rental, what you're paying on a year-over-year basis. So during the pandemic, overall rates increased 15%. So the average rate a guest was paying. A big piece of that, though, was sort of a composition shift. So we went from people staying in studio and one-bedroom apartments to staying in 3 and 4 and 5-bedroom homes. So what we did was we created sort of a same-store series, a repeat rent index, that's the RRI. And there we actually saw rates come down with the pandemic and growing about 5%. And then once we sort of saw those really high occupancy levels in 2021, that's when rates really started to accelerate for both hotels, short-term rentals, sort of feeding into the broader inflation equation. Since really April of 2023, though, we've seen almost no growth in ADR. On the guest paid side, it actually started going down as business travel and sort of urban travel started to come back. Again, mix shift. But on the repeat rent series, and it was essentially flat. And only in the past 3 months, so remember on the occupancy slide, we sort of started to plateau, and that started to give people some pricing power again. So just like we've seen some re-acceleration in CPI nationally, we've seen that same sort of re-acceleration in pricing power for guests, or for hosts nationally. Still only 5% growth, but growth nonetheless. And then that sort of breakout by city, we see it dramatic differences. I won't go into that, but fun slide. So Airbnb, we talked about sort of now the dynamics leading to the weakness for Vacasa. I want to talk some about sort of the growth story for Airbnb, because it has been a company in a sector that has seen really significant growth over the past 10 years. So I said 25% of every dollar being spent on lodging was in short-term rentals today. Just 5 years ago, that was 15%. Just 10 years ago, it was negligible. It was maybe 5% of total lodging. So really massive increase in expansion, up 1,200% since we started collecting data just 10 years ago. And what I think, yes, this is a big growth, but it's sort of fun to dive into the composition and sort of what's leading to some of the growth. So we track all the demand that's happening on Airbnb and Vrbo. And one thing that's fun is sort of look at the guests and the people that try it and the people that keep using it over time. So what we look at is both in each year, how much of the overall demand was new guests versus returning guests. And so we're seeing about 6 million new guests each year try it for the first time. Of that 6 million new guests, only about 20% keep using it. So 80% sort of say like, oh, that was great, but it's not for me. But what that 20% does is start compounding, and where you see the existing guests sort of keep getting added in from those new guests that come in each year. And they've been consistent and able to add new guests into the platform. And overall, what we see is people actually really like it compared to hotels in terms of guest satisfaction scores. But what's really interesting is people really like it when it's a one-on-one experience. So when you're working with someone that just has 1 or 2 units compared to working with the big property management companies like a Vacasa. And what's great for Airbnb, so you see the highest guest satisfaction scores across every single sector are ways that they sort of ask the question being for the 1-unit operators. And then when you look at their sort of breakdown of operators, 66% of the hosts on Airbnb just have 1 unit. Another 28% have 2 to 5 units. So, and only 1% of the hosts on Airbnb are professional operators. Yes, those professional operators might have a disproportionate number of the listings and of the revenue, but it's still half the overall revenue being earned in the sector is being generated by someone with fewer than 5 listings. And that's something that Airbnb and Vrbo has really been trying to protect and help sort of foster, is that you can be an individual entrepreneur with your second home, with an ADU in your backyard, with a private room that you're just renting out, and it's sort of good for both the host and the guest. And it's a fun sort of matching problem of you got people with underutilized real estate, you got people that want to travel, sometimes to areas that don't have hotels, and how can they sort of facilitate that matching between host and potential guest. And we were talking a little bit earlier about just what was going on in the hotel industry in terms of overall supply. So for a long time, in terms of total net number of new units, the hotel and short-term rental industry were essentially adding 100,000 listings each per year. 100,000 new hotel rooms each year, 100,000 new short-term rental listings each year. And with what's been going on in the broader commercial real estate sector, and really regional banks being unwilling to lend on new hotel construction, even though the fundamentals of the hotel industry are actually really good right now, it's led to almost no new hotel construction. You look out over the pipeline, and we can see like pretty clearly over the next 2 to 3 years, we're going to be below 1% growth in hotel unit inventory growth pretty consistently. And that's going to end up being a decade of below 1% growth when the industry is typically growing about 2% a year. So one, that's going to be great for existing hotels because they're going to be able to earn pretty high occupancies, but also provide an opportunity for the short-term rental industry, which is still now growing at 100,000 listings per year, to continue to pull back share. And this looks at overall share between hotels and short-term rentals. And you see that share sort of growing over time. The other question, and I'm just about done, we get asked about a lot is the impact between hotels and the broader housing inventory. Because, and if you think about supply and demand, as every potential short-term rental could be a housing unit. And as the short-term rental industry grows, so we saw US short-term rentals go from 100,000 to 1.5 million over a 10-year period. Like, is that pulling housing inventory out that could be used for long-term renters or homeowners, and overall pushing housing prices up? And one, we've done a lot of research, a lot of outside groups have done a lot of research, and the number I like to quote, and it was an Oxford economic study, sort of, let's say housing prices increased about 30% during the pandemic, or over the past sort of 4 years. They can attribute about 1% of that overall 30% increase to increased supply of short-term rentals. So does it have an impact? Yes. Is it a main driver of the rising home prices? Absolutely not. And there are some great sort of legislation going in to sort of help guide sort of short-term rental growth in the areas where it's good, and pull back on the areas like workforce housing, where you really don't want those units going into short-term rental inventory. And then sort of some of the numbers I like to point out, because most of short-term rentals, I called out 45% of the inventory was in coastal and mountain markets. A lot of this inventory is in people's second homes that would have otherwise been sitting empty. And as an economist, when I see all this real estate sort of sitting empty that could sort of be used to drive economic activity and tourism spend in these markets, like that actually be a great thing for both those local markets and for the homeowner. And the census counts the total number of housing units that are vacant and either used seasonally or occasionally. And you sort of think about that and like, well, that's probably what short-term rentals would get counted in the census's sort of count of housing. And as of today, there are 5.5 million housing units that are vacant and used seasonally or occasionally. And sort of just plotting that back, and this goes all the way back to 2000, I sort of called out the 6.8 million number, because that's when Airbnb started. So from the time when Airbnb started to today, we've lost 1.3 million housing units that are now essentially owner-occupied. So I'd argue that, and broadly, yes, we can sort of show specific areas where it has an impact on housing, but when you look at the broader overall housing trends, and over that period, we've seen the total number of housing units go up and continue to grow up, and you look at seasonally, occasionally used homes as a percent of the total housing stock, we're at an all-time low, just 3.8%, where it was north of 5%. And when we look at our forecasts for the industry, we do expect supply growth to slow. So I didn't get into it, but a lot of the dynamics that sort of drive supply, we talked about 2022, 2023, the high supply growth, a lot of that was the outsized earning potential. Well, that earning potential has shrunk with the occupancy and ADRs coming down. Housing prices continue to go up. Interest rates, have you guys looked at interest rates lately? They're really high. So the dynamics of actually investing in a second home or an investment property aren't great. And that's sort of leading into supply declining, or supply growth declining. Supply is not going down. We don't expect it to go down, but the sort of investment opportunity has definitely come down from the highs in 2022 and 2023. And with that, happy to take questions.
I was going to say, back in the 90s, I went on vacation, and the trendy thing was stay in bed and breakfast.
Yep.
Where you were in somebody's home, but they cooked you breakfast, and you kind of interacted with them and all that stuff. Whatever happened to that, and did those all turn into Airbnbs, or is that kind of a separate thing?
Yeah, bed and breakfasts are still going strong. I'd say there's actually been a great benefit for B&Bs that they can now list on platforms